Why do traders struggle psychologically? Why can't they follow the rules? You may have a really good edge. You may have a really good setup. You may have really good everything. You may have many years of experience that um, make you a great trader, right? But the question is why? Like, why do I have these giant, huge red days? Why do I consistently blow my accounts? Like, what is happening, right? Uh, a lot of traders I've met will say that they have really good edge, but the problem is that they just can't follow the rules on the days where they really need to. And I can attribute this, right? The first thing that we should do is we should ask why, right? People will say tilt. People can't define tilt. People can't, in the same way people can't define why they can't follow the rules, right? So I'm going to explain how this works in relation to trading. The topic will be about decision fatigue. Decision fatigue is the more decisions that you make, the worse your results will be, right? There are many evaluations that a trader makes before placing one singular trade, right? We understand this when we back test, we can see things objectively, right? When we back test, we have nothing to lose. So there is no stress, there is no worrying. You just are simply you're thinking in a probabilistic way. So when you back test, you are consistently making quality decisions because there is no pressure. Okay. Also, the losses don't necessarily feel real. You're thinking when you backtest, you're looking at 1 hour, 2 hour, 3 hour, 4 hour. It's not as impactful as thinking I just lost $200, $300, 500,000, $1,000. It's not the same thing. So, uh, what ends up happening with decision fatigue is you have a bunch of these evaluations that you need to make, right? What's the news? What's the catalyst? What's the daily chart look like? What's the intraday chart look like? Are the confluences good? Is the trend correct? Is my read correct? Like, do I hold? Do I cover? Do I scale in? There's a lot of different evaluations that need to be made before actually placing one singular trade. There was a study done by the Bureau of Economics where basically they found that the more decisions professional financial analysts had made, the quicker they were to make decisions based on less evaluations. Meaning that the more forecast they made, the quicker they were to go back and kind of just like sum everything up into less and less parts, right? That's because the brain does not want to work as hard on the second, third, fourth, fifth decision that they the same way that they did on the first decision, which is why decision fatigue exists. Okay, there is a loop that happens when you get stressed and you start losing money. You go from thinking objectively, thinking in a probabilistic way, to now thinking, can I make money back? So you go from thinking in a probabilistic way in which you were evaluating all the different factors that go into a trade, now reducing those evaluations to extremely less amounts of evaluations in order to try to get to the root, to try to feel better about the fact that you've lost money. And this creates a spiral, which we call tilt. Okay, so now what is tilt? In a trader's world, I would at least assume that it would come from making repeated decisions that lead to the same response, right? So you scan, you evaluate, you reject, evaluate, enter, manage, exit, reassess, scan, evaluate, reject, enter, manage, and exit, right? So it's a deadly loop, right? You make the scan for your setup, you evaluate the setup, you reject it, which means that you don't take the setup. You evaluate, you finally enter, you manage the setup, you exit, you reassess, scan. It's this complicated loop where basically you are indirectly reinforcing a negative outcome by continuously making worse decisions over time, right? So I would argue that your first decision is better than your second is better than your third is better than your fourth, and because your first decision was wrong, right, and you've reduced the amount of evaluations made in every single trade, then on your third trade, if you've lost 1 and 2, you're just going to more than likely, because everything is probabilistic, more than likely end up with another loss. It potentially worse, right? Because you're now reducing the amount of evaluations. By the time you get to the 10th trade, you now have minimal to like no evaluations on your trade, and now you're just straight up gambling. That is often what ends up happening. Or you go into like this fight or flight mode where you just say, F it, I don't care, I'm just gonna let it run and let the odds of of whatever play out and hope that I can make my money back. And that's ultimately where people end up blowing up the most, because they've now eliminated all of the evaluations, all probabilistic thinking, to now bare bone fight or flight response, in which if they are wrong on that last decision, that very well ends up to a blow up in a lot of cases. Of course, you can be lucky, and there are times where you go maybe negative 10R and come back green on the day following these like nasty behaviors, right? But it only takes one day of continuously just staying at the charts and making worse consequential decisions. It looks like this. So tilt, again, I want to kind of lay out what tilt looks like, because I think I explained it a little more complicated before, but it looks like this. You have a decision, then you have cognitive fatigue, then you have lower discrimination between what good and bad opportunities are. You make more trades, which creates more emotional involvement, which then creates more decisions. And I don't know if you caught this, but we started this whole loop with making a decision in the first place, right? So decision, fatigue, lower discrimination between good and bad, more trades, more emotional involvement, which means you are now more likely to place more trades. It's this disgusting loop. And at the end of the day, we all go through this. It's very difficult to break out of this type of psychology. I always recommend that the solve is to limit the amount of trades that you make, right? You can do a study based, especially if you have a habit of over trading, you can do a study on your worst days. If you don't want to take what I say, do a study on your worst days and look at the pure amount of trades that you make versus the amount of trades that you have on your best days. You'll actually find a clear comparison between that you will have most likely more trades done on red days than you have on green days. Logically speaking, you should take the average amount, or like the higher end of the amount of green days, the amount of trades that you take on green days, and apply that framework to your overall day. So that way, you know that if you take 3, 4, let's say you have 5 average trades on a green day, if you're like a scalper of some sort, right? And on a red day, you have like 30, right? Logically speaking, you should probably limit yourself to like 5, 6, or 7 trades within a day, because every point after is obviously now deteriorating your ability to make good judgments. So there's lots of impact, but that is basically psychology with how to address the psychological parts within trading. Hope this helps.